Did you know that taxes are one of your top 3 expenses, up there with housing and transportation? For example, if you're making $70,000 in Canada, you're paying anywhere from $16,000 to $17,000 in taxes, CPP, and EI every single year. That's almost a quarter of your income. While taxes can seem boring and intimidating at times, as a Canadian, I believe it's so important to be knowledgeable about the tax benefits out there so that you could keep more money in your pockets. Hi, I'm Gabrielle, a CPA and tax expert. In today's video, I'll be covering the GST HST Holiday, new contribution limits for the tax-free savings account, the TFSA, registered retirement savings plan, the RRSP, first home savings account, the FHSA, the Canada pension plan, the CPP, and the new pension enhancement, as well as changes in the tax brackets. I will end with the new capital gains tax released in 2024, as well as new tax benefits for entrepreneurs. So let's jump right into it. GST HST Holiday. I'm just briefly going to touch on the GST HST break that the federal government has proposed. It's a temporary relief on GST HST for holiday essentials from December 14th, 2024 to February 15th, 2025. This includes items like food, beverages, restaurants, children's clothing, diapers, toys, books, newspapers, and Christmas trees. How this might apply to you is, let's say that you spend $100 on items that qualify for the break. You will save $5 in BC where the GST rate is 5%, and you will save $13 in Ontario where the HST rate is 13%. Now let's move on to the tax updates that are actually here to stay. Tax-free savings account, TFSA. The tax-free savings account is a tax-sheltered investing account that was first released in 2009 and that is flexible and can be used towards any savings goal that you have. In a TFSA, you invest your money and earn income like interest, dividends, and capital gains tax-free. Typically, if you were to invest in a taxable account, you will be subject to tax on your earnings every single year. But in a TFSA, the compounding tax savings over time can be significant. The great thing about TFSAs is that you can withdraw from it anytime without any penalties. The only catch is that the withdrawals made will only be added back to your TFSA room in the following year. How much you can contribute to your TFSA is determined by your contribution room, which grows every year by the TFSA annual room limit. As you can see here, the 2025 TFSA annual room is the same as 2024 at $7,000. Your TFSA contribution limit accumulates over time and any unused room is carried over, so it doesn't disappear. For example, if you are born in years 1991 or earlier, which means that you were 18 or older in 2009, your cumulative TFSA room is now $102,000. Make sure you know your limit because any over contributions are subject to a penalty of 1% per month. Just to hit this home, let's say that you maxed out your TFSA room of $20,000 in 2024, but you ended up taking out $10,000 in June of 2024 to pay for things. If you recontribute back the $10,000 in September of 2024, you will be hit with a penalty of 1% per month on the over contribution. That means that you can't put back the $10,000 until the following year in January of 2025. So be careful of your withdrawals and recontributions during the year. Better yet, you can plan when to withdraw the money, let's say in December of 2024. That way your contribution room gets reset related to the $10,000 withdrawal in January of 2025. Registered Retirement Savings Plan, RRSP. The RRSP is a government registered account designed to help Canadians save for retirement. With an RRSP, you can invest your money and earn income such as interest, dividends, and capital gains on a tax-deferred basis. This means the earnings within your RRSP grow tax-free until you withdraw them. The idea is to access your RRSP during retirement when your income and therefore your tax rate is expected to be lower, allowing you to save on taxes overall. One of the biggest advantages of an RRSP is that your contributions are tax deductible. This can reduce your taxable income or potentially even put you in a tax refund position. However, since RRSP contributions give you an immediate tax benefit, withdrawals are subject to withholding tax and must be included in your taxable income for the year. It's important to note that you can only contribute to your RRSP based on your RRSP deduction limit, which should be on your notice of assessment. Any over contributions are subject to a penalty of 1% per per month, and it can be quite a pain to fix, so make sure to always check your RRSP limit before making a contribution. The RRSP deduction is generally the lower amount of either 1, 18% of earned income from the prior year, or 2, the RRSP dollar limit. In 2025, the RRSP dollar limit is $32,409, which is indexed for inflation every year. So for example, let's say that you make $100,000. Your RRSP is the lower of 18% times $100,000, which is $18,000, or $32,409. In this case, your RRSP contribution room is $18,000. In another example, let's say that your income is $200,000. Then the lower of 18% times $200,000, which is $36,000, or $32,409. In this case, your limit is $32,409, the RRSP dollar limit. If you don't contribute to your RRSP or you haven't maxed out your RRSP room, your RRSP limit does get carried forward and accumulate, so you can contribute anytime in the future. If you are a first-time home buyer, one of the tax accounts you should be taking advantage of is your RRSP for the home buyer's plan. As mentioned previously, if you withdraw from your RRSP, you get taxed on the withdrawals since you received a tax deduction. However, if you withdraw from your RRSP because you are buying your first home, then the withdrawal can be tax-free up to $60,000 after April 16, 2024. This is a drastic increase from historical withdrawal limits of only $35,000. But keep in mind, you do have to repay this amount over 15 years. So if you withdraw $60,000, you would need to recontribute to your RRSP under the home buyer's plan at $4,000 per year. And if you don't recontribute, you would need to include the $4,000 of income on your tax return. The good news is that you don't need to start repayments until 5 years after making the withdrawal, which is actually a significant extension from the original 2-year grace period. This additional time provides more flexibility, allowing you to adjust to new mortgage payments and manage the other expenses that come with home ownership. First Home Savings Account, FHSA. The federal government released a new types of savings plan in 2023, which aims to help Canadians save to buy a qualifying first home tax-free. Perhaps the most exciting feature of the FHSA is that it combines the best parts of the TFSA, in which you can withdraw from it tax-free, and the RRSP, in which you could get a tax deduction for your contributions. You can also withdraw tax-free if it's used towards a qualifying home purchase. The contribution room grows by $8,000 per year, starting in the first year you open your FHSA account and up to 5 years. That means that you can max out your FHSA by contributing up to the lifetime FHSA limit of $40,000. Once you open your FHSA, you can also carry forward the unused contributions to be used in a later year. So if you open your FHSA in 2003 but didn't contribute the $8,000 limit, you can carry forward that amount to 2024 and contribute a total of $16,000. However, the maximum contribution room that you can carry forward is only $8,000. This means if you opened an account in 2023 but didn't contribute in both 2023 and 2024, only $8,000 gets carried forward to the 2025 year. So in any given year, your contribution room never exceeds $16,000. The $8,000 carried forward from the prior year and $8,000 for the current year. Remember that over contributions are also subject to a penalty of 1% per month. The main difference between the FHSA and the home buyer's plan, which is under the RRSP, is that your withdrawal is $40,000 versus the $60,000. This means that you could withdraw $20,000 more tax-free under the home buyer's plan. On the other hand, under the FHSA, you are actually not required to pay back the $40,000, whereas under the home buyer's plan, you would need to pay back the withdrawn amount over 15 years, as previously discussed. Otherwise, the amount gets included in your income. But if you happen to have enough savings, you can also take advantage of both the FHSA and home buyer's plan so that you can make a combined original contribution of $100,000 tax-free towards your first home. Canada Pension Plan, CPP. CPP is a pension available to Canadians when they retire that pays out a monthly taxable benefit. You can start receiving CPP when you are at least 60 years old until the rest of your life. The standard age to start the pension is 65 and the latest is age 70. For 2024, the maximum monthly amount that you can receive if you start your pension at age 65 is $1,364.60. The average monthly amount paid for a new retirement pension at age 65 in July of 2024 was $815. Your situation will determine how much you'll receive up to the maximum. However, in order to receive this benefit when you retire, every person over the age of 18 who works in Canada and earns a minimum of $3,500 per year must contribute to the CPP. How much you contribute depends on your employment income. You may have noticed CPP as one of your deductions from your paycheck. And while it may seem like another tax, technically, it's money that you will see back when you retire. In fact, your employer also contributes towards your CPP as well. In 2025, the CPP contribution rate stayed the same at 5.95% of your earnings, the same rate as 2024. However, the 5.95% applies to maximum annual pensionable earnings of $71,300, which is up from $68,500 in 2024. This means that if you earn more than the maximum annual pensionable earnings, you're capped at the maximum CPP contributions of $4,034.10 as an employee, up from $3,867.50 from last year, which is an increase of $166.60, and your employer will also have to match that amount. If you are self-employed, you will need to pay both the contributions as an employee and employer up to a maximum of $8,068.20. But that's not all the changes to CPP in 2025. There is now a second additional CPP contribution that began last year on January 1st of 2024 for workers who have higher earnings. It's important to understand the first earning ceiling, which is $71,300 as mentioned previously, and the new second earnings ceiling, which is $81,200 for 2025. This means that you take the difference and apply a contribution rate of 4% so that the maximum you would pay if you earn $81,200 or more is a maximum additional CPP contribution of $396, which also needs to be matched by your employer. This is an increase of $208 from last year. Just to bring it together, if you earn $81,200 or more, you are paying a maximum of $4,430.10 in 2025 towards your CPP, which gets deducted from your paycheck. Your employer is also contributing $4,430.10 towards your CPP as well. If you are self-employed, then you need to pay both the employee and employer contributions of $8,860.20 towards your CPP. Tax brackets. Lastly, we'll be going over the tax brackets and any changes to the tax rates. As a Canadian, you'll be subject to two separate tax rates, the federal and the provincial or territorial. You can see here that the federal rate on the first $57,375 of taxable income is 15%, and the BC provincial rate on the first $49,279 is 5.06%. This is confusing for two reasons. First, the taxable income buckets are different for federal and provincial. Second, you are working with two different rates, the federal and the provincial rates, which you would actually need to combine to get your applicable rate. So I like to use the combined federal and BC provincial rates table to get a better idea of the tax rate that will impact me. In this table, you can see that the first $49,279 of taxable income is subject to a combined tax rate of 20.06%. And keep in mind, while this concept of a combined tax rate is the same, all the provinces and territories will have different tax rates. So feel free to look up the combined federal and provincial or territorial rates that are applicable to you. Another thing that you need to understand is that we have a progressive or graduated tax system, meaning that your income is taxed incrementally based on the tax bracket that you fall under. So if you are wondering if it's worth it to get that pay increase or bonus, you should always say yes, because you are getting taxed on the incremental income that you are earning. So if you earn $70,000, you get taxed at 20.06% on the first $49,279 and 22.70% on income between $49,279 up to $57,375, and then 28.2% on income over $55,375 up to $98,506, or $70,000 in our example. It does not mean that if you earn $70,000, only the last applicable tax rate of 28.2% gets applied to your entire income. So if you get a $10,000 salary increase, only your income above $55,375 up to $80,000 will be taxed at 28.2%. Now, going over the tax rates here, there is some good news with the tax brackets being more favorable to Canadians. You can see that the tax rates itself haven't changed, but the tax brackets themselves themselves have increased. What this means is that higher income is actually getting taxed at lower rates. And you can especially notice this in the highest tax bracket, in which the highest taxable income in 2024 was $252,752, and going into 2025, it's now $259,829. This means that $7,077 is getting taxed at the lower rate of 49.8% instead of the 53.5%, which equates to only about $262 of tax savings compared to the prior year. New capital gains tax. Now, there's been a lot of drama around the new capital gains tax. As of June 25th, 2024, the capital gains inclusion rate increased from 50% to 66.67% for individuals with capital gains exceeding $250,000 in a given year. For most Canadians who have capital gains less than the $250,000, the new capital gains tax doesn't affect you, and your inclusion rate stays the same at 50%. However, it will affect you if you had a large one-time transaction exceeding $250,000, such as selling your investment properties like real estate or stock portfolio, or you own a corporation that has disposed of assets after June 25th, 2024. If this applies to you and you are an entrepreneur and you're wanting to know about the increase in tax benefits related to the lifetime capital gains exemption and the new Canadian Entrepreneurs Incentive, make sure to check out my video linked over here, which goes into more details about how it directly impacts you. That's a wrap for the 2025 tax updates for Canadians. Thank you so much for watching, and I'll see you guys in my next video over here. Bye!